Welcome to Central Bank Central. I'm Kathleen Hayes. So, 1 week from now, the Federal Reserve will be wrapping up its March policy meeting. The question going into this has been pretty much, will the Fed cut rates again now? Probably not, but maybe signal that the door is open, especially as inflation continues to gradually improve. However, only what, 2 weeks ago, we found out that we were in a war in the Middle East, which has caused a major energy shock, mark prices going up and down, and making people wonder what that will do to inflation, the economy, and the Fed's decision making. So I'm very happy to welcome back to Central Bank Central Loretta Mester. Loretta served as president and CEO of the Federal Reserve Bank of Cleveland from 2014 to June 2024. And she's worked before that nearly 30 years at the Federal Reserve Bank of Philadelphia, where she rose to be executive vice president and director of research. And in fact, that's where I first met her and where I first did an interview with her. So, Loretta, we're keeping them up, aren't we?
That's right. Thanks for having me back, Kathleen.
Well, it's wonderful to have you. And of course, one day to the next, the markets seem, certainly the markets are volatile. But I wonder, I want to talk about the CPI report that was out today. I said pretty tame. But what about the oil price shock? Because this is something that the Fed's going to have on its lap, on the table, at the policy meeting. Um, how much will this dominate the discussion? Not necessarily the decision made right now, but what they're looking at, what they think the risks are, et cetera. You've been there, done that. What do you think could be going on?
Well, certainly the report that came out today gave them a good picture of where things were before the oil price shock. And it kind of continued the story, which was there's been continued pass through of the tariffs into goods prices, right? We've seen some better numbers on housing. The housing inflation is coming down because rents have basically been coming down for a while, and that's now showing up in CPI. And we got okay news on the services excluding housing. That didn't move up, which was, what people had been looking for. It moved down a tad. So that's a baseline, but it's very backward looking. So you're exactly right, Kathleen. I think what they're going to be talking about is what are the implications of the war and the oil price shock and the supply disruptions that we're currently having for both inflation, but also for growth and then, of course, employment, which is part of the mandate, the employment part of the mandate and the inflation part of the mandate. And frankly, they're not going to really know how long, right, the oil prices will stay at elevated levels. They'll make some they'll use the models to sort of work through that. Now, I can say that the model that the Fed uses, and I think most other macro models, generally would show that an oil price shock of the kind that we're talking about and the duration, of a couple of months that isn't persistent or that persistent has some dampening effect on growth and raises total headline inflation for a time but doesn't really pass through much to core inflation. And that's kind of the dynamics of the model, right? So you might get a pretty strong increase in headline inflation for a while because
Hmm.
it was an energy price shock. But in general, in 6 months, in 8 months, that'll be over. And then, you don't get much pass through core and you get some dampening effect on growth. And so most people would say, well, then central bankers will be looking at sort of the effects on growth more than the effects on inflation. But I think in the current context, that probably isn't the way. I mean, I certainly wouldn't be looking at it that way if I were still on the committee. And I think most committee members will be taking into account the full context of where we are now, which
Okay.
is
Yes.
inflation having been elevated above goal for 5 years, right? And the fact that one thing we learned in the pandemic is, right, that inflation can rise, even if you think the Phillips curve is flat, right? If you have
Yeah.
supply constraints that are affecting the economy, if you have enough demand, right, you can get inflation because demand will outpass
Yes.
supply. So I think in the context of what the current environment is, that's kind of the way they're going to be thinking about it is, okay. So then what are the issues there? One is the growth effect may not be as large as it used to be because we're now an oil exporting country, right? So, an oil price shock actually helps some of the producers here
True.
right? So the impact on overall aggregate demand in the US is less than it would have been like in the 70s, or even the
Okay.
90s, right? So the effect on the growth side is less. The effect on the inflation side, I submit, might be larger than the typical look through the oil price shock for two reasons. One, um, I think firms have been bearing the brunt of the higher tariffs, right? So their margins are already, right, been tight. They have, they want to rebuild their margins to make up for the cost
Right.
of the tariffs. Now this oil price shock on top of it, they may be induced to raise their prices. So the second round effects from the oil price, which would show up in core inflation, might come a little sooner than it might
Okay.
have come in the
Well,
past. And
Loretta, you
secondly,
go ahead.
if I could just finish this point, inflation expectations are not as anchored as they were, and that also is something that the Fed will be very concerned about.
Well, you just anticipated my next four questions. So let's look at this because you'll cover a lot of ground, and I think that was my next question. The Fed's biggest problem, it's missed its 2% target um, uh, for 5 years running. You said it, right? So in a sense, but also we've noticed there's a number of somewhat more hesitant and hawkish people on the Federal Open Market Committee now, right? There does seem to have been a bit of uh, that seems to be on the table too. So at some point, and in terms of Fed credibility, et cetera, you mentioned that. But in a sense, does this give the Fed more time to wait and see what it does next? Because now there's this big event, right? What's the impact going to be? Uh, is that going to be something you think that they can kind of sit back, okay, wait and see, and go from there?
Well, I think they will pause. I mean, they're not going to do anything next week, right? And I think they may be on hold longer than that, depending on how the economy evolves. But it's really going to depend on how the economy evolves. So nothing has changed in terms of Fed's always looking at what's the current conditions. What's the forecast? Where do they think things are going? What are the risks around that forecast? Things could evolve differently than they think. And then where do you position policy? So this is all going to be about managing policy so that it's in a good position once things become clearer. That's one thing we didn't do that well when I was on the committee in the post-pandemic, right? We allowed policy to be far away from where it needed to be when the inflation became more persistent, and therefore we had to raise rates, very aggressively. So again, right, what they're trying to do is make sure they're in a good position. I think they are. I think they're in a good position. So let's think about, well, what would be the spur, right, to allowing them to, for example, cut rates again, right?
Okay.
Okay, well, one, you'd have to sort of get evidence that, or see, convincing evidence that inflation after the oil price shock is continuing to move down, right? That there wasn't a disruption in inflation expectations, that they are remaining anchored, and it seems that inflation has resumed a downward trend and is heading towards 2%. Right? That would be a good outcome in terms of where they want to be. Secondly, right, you want to be able to say the labor market, it hasn't deteriorated more. If the labor market deteriorates more, that would spur, I think, they'd have to balance the risk to the inflation part with the risk to the labor market. And I think this committee, even with the change in voters, I think they have shown that they take the labor market side of the mandate, maybe, see risks around that more than perhaps the inflation risk. At least they did last year. We'll see. Right. But if that deteriorates more, then I think that could get them to start moving rates down again. Or if there's a financial stability issue, which with the volatility we've seen in the markets, we know there's some private credit underwriting issues, right? If that were to evolve into something much bigger than it currently is, you can imagine that a central bank would want to take that seriously. That wouldn't necessarily be a monetary policy action, but it could be something that would spur them to ease up. So
Okay. Well, go
that's on
ahead.
the easing side, right?
Okay.
I don't think that they would be spurred to raise rates again. I think the modus would be more to, if they see inflation maybe not resuming that downward path, they're just going to hold for longer, I think, at this point, unless they saw something that was very different than what we're expecting on the inflation side. I think it
You
would be
know,
hold longer and don't raise
right.
the rate.
Then rather than actually raising rates. How about big win for Federal Reserve people, a lot of economists, inflation expectations. As long as they're anchored, you may remain optimistic that ultimately it's going to continue to come down, even if it's very gradual. What do you see there?
Well, so I've always told people, yeah, inflation expectations, if you think about post-pandemic period, the short run went up, but the medium and longer runs were always viewed as being consistent with the mandate, and yet we still got very high inflation. So I always tell people, well, look, it's sort of a necessary condition, but it's not a sufficient condition to have inflation at your goal, right? It's necessary to make sure that you maintain inflation expectations, right, consistent with your goal of 2%. But just because they're not moving up in the medium and long run doesn't mean that you can't get inflation. And I think that's something that people sometimes forget is that, during the pandemic, post-pandemic period, we had relatively stable, longer run inflation expectations. They went up a little bit, but they weren't what people considered unanchored, and yet we still got very high inflation. So I think that they should be doing all they can to make sure they maintain those, but they also have to be evaluating whether aggregate demand is outpacing aggregate supply. And given that aggregate supply is going to be constrained for a while because of what's going on in the war, I think they have to be very attuned to that. And on the aggregate demand side, we know that fiscal stimulus is there
It,
and is coming. So
yeah,
again, they're going to have to be doing that balancing act, even if they view inflation expectations as being stable. One caveat on the inflation expectations that I think people have to realize is that gasoline prices, which have gone up quite a bit, are one of these what we call salient prices for determining how consumers evaluate inflation. So, there's a lot of research that says like when those prices go up, and it turns out egg prices are another one, and milk prices are one. Those kind of prices that you're buying on a regular basis, that consumers are buying often,
yeah.
those seem to have a bigger impact on inflation expectations. So again, there can be follow-on effects from just the impact on of a high oil price for a time and then it coming down. That can have a follow-on
Yeah.
effect that and spurs other inflationary trends in the economy.
Well, I'm glad you made your comment about eggs. 'Cause I remember when COVID started, and all of a sudden we're going to the grocery store and coming back and saying that two bags used to cost $60. Now they cost 100, and the egg prices went up, and I eat a lot of eggs. So that was a big one for me. Inflation makes me stronger indeed. But in terms of the number, I want to ask you a very specific kind of nerdy econ question because we saw the CPI in the February number was headline was up 0.3. That was a little bit higher than zero point 0.2 in January. The core was up 0.2 compared to zero point 0.3 a month ago, et cetera. Seasonality, what they call it, the seasonality of
Residual
how.
seasonality.
Yes,
Yeah.
exactly. At the beginning of the year, often the number goes up and then
Right.
maybe it comes back down. But it seems like we didn't see that so much. So in a real nerdy way, are you a little bit encouraged, should be encouraged, at least going into March and into what's happened in the Middle East, that if you normally see the seasonality, but you don't, does that mean actually that's a sign that inflation in another way is continuing to ease just a bit? And in fact,
Well, I think the story that inflation is starting to ease is probably right, right? I think it is hard to read through some of these numbers. And of course, we had delayed reports, and we're going to get the PCE report, which is, of course, the one that the Federal Reserve focuses on. We're going to see that on Friday. And so I think all of that data, right, is going to tell a story. But given what we've had since that time, I mean, usually we always say, well, the official statistics are backward looking. In particular, this time, I think it's hard but backward looking is okay because what you're trying to do is extract the trend going forward from the data you have. I think what's different now is it's going to be hard to extract a trend given the oil price shock, the uncertainty around, right, what's going to happen. I mean, uncertainty itself can have an impact on the economy, right? And then you
mhm.
layer on top of that the oil price shock. which is impacting, right, what people are paying out of their pocket. It may hold down inflation in other components because demand will be less on those components because people have to pay
Right.
for the gasoline. But nonetheless, I think all of that makes it very difficult, right, to have much confidence that inflation is on a downward trend back to 2%.
Okay.
If we were starting either at or below, right, the level, I would be less concerned. But we're above the level and we've been above for a long time, which is why I would be focusing in on the inflation side right now, unless we get more evidence that there's a much more, you know, severe or material deterioration in the labor market. And the labor market is soft. It's not as robust a labor markets that you like to see. Most of the job gains are in healthcare.
Right.
It's not broad-based. And it's reasonable for firms to be very cautious in their hiring because we are in this uncertain environment. And so you can explain what's going on in the labor market by some of the uncertainty that is affecting the rest of the economy as well.
It's interesting because the Cleveland Fed just put out one of their economic research reports looking at the seasonality, looking at it in the PCE and showing how that is such a strong trend from looking at the November and December numbers and then looking into January. You see that
Right.
frequently. So if anybody wants to go to the Cleveland Fed, you can read it right now. Oil price shocks. First of all, again, what's going to be said at the table, right? What's going to be said at the table? Jay Powell starts, everybody's going to chime in. Is there going to be any kind of debate or looking at the history of oil price shocks?
Well, they're certainly going to look at, right, other events in the past where we've seen these large increases in oil price shocks. They're going to look at the duration of those shocks, and then they're going to look at the impact that was seen in the economy. I'm hoping what they do is also look at what they predicted would happen, right? Because they're going to be, or, next week they're sitting there saying, okay, our models are telling us that this is the outcome that we expect, right? Small downside on growth, temporary increase in headline inflation, little pass through to core inflation. It'd be good if they're looking at these past episodes, not only in what actually happened, but how well did the models capture what happened so that they have a lens to look at sort of, okay, how much should we take the model to heart this time? Right? And how much error bands are around, confidence bands should we have around those forecasts? It's that forecast that we don't see much pass through to core, which is the basis for saying, okay, we can sort of look through the inflation impact of the oil price shock and maybe focus on a demand side and see how much demand side downward, effect we'll have. And as I say, I think the models, the more recent models would show that we're going to have less of an impact just because the US economy is less dependent on oil. We're exporting oil. We do import some things like jet fuel, and fertilizer and things that'll be affected. But in terms of overall oil and natural gas, we're exporting. And so that means the impact will be less than in the past.
Well, it's interesting. That's another thing I was wanting to ask you about, and that is, um, well, certainly the COVID example, but even going back to the 70s, the whole thing of how if you react to it, should the Federal Reserve react to supply shocks because they're generally temporary and it's a demand shock or demand difference. And I think is that also the lesson there that it could be a mistake if you try to accommodate this in some way?
Well, it would be a mistake to try to accommodate if you're in an environment where aggregate demand is outpacing aggregate supply, right? So in COVID, that was what we didn't fully understand is how strong aggregate demand was, the fiscal stimulus that was in the economy, the, very accommodating monetary policy that had been, in effect for a while. Aggregate demand outpaced supply. It was out of balance with supply and supply was constrained. So you got an inflationary impulse in the economy because we didn't keep it in balance, right? We should have been moving rates up sooner than we were, right? Because aggregate demand was outpacing supply and adding those pressures. if we're in that kind of, if you're in an environment where, for example, markets are tight, there isn't a lot of labor supply, right? Then anything, right, that means demand is going up, for example, the fiscal stimulus, right? Then that can mean things out of balance. And so a supply shock, right, that constrains supply can have a more permanent effect and not just a one-of effect that you can look through. It's same way with the tariffs, right? The tariffs are being interpreted as one of price level changes, right? And then once that feeds through to inflation, it's not inflation anymore. And that could very well be the way to look at this because we haven't seen, right, a big reaction in expectations about it. But I still think the Fed needs to be looking at actual inflation and then the projections to make sure that their projections are on track. Because if they, again, underestimate persistence, their policy rate could be out of, position and it'll be harder going forward to put it back into position to actually get the inflation pulses down.
So, as you continue to watch the economy so closely, um, you know, uh, in terms of oil prices generally, what do you see? Do you see, okay, and I've talked to people say, oh, on the the Sunday after the war started, right after, I did an interview with someone who figured good chance, wasn't necessarily predicting it, but the war would
Mm,
be over quickly, and there wouldn't be regime change and oil prices would go up and they were all over the map, for that first weekend.
mm.
What is your sense then? You talk we're oil exporters now. How how do you see that fitting into the equation? Is this something that however long it takes, that is something, right? That will be temporary, that oil prices will come back to some kind of equilibrium that is maybe makes gas prices a little bit higher, but really not that much. Or do you see any reason why this would be more lasting?
Well, we don't know how long the conflict's going to last, right? So it's kind of hard to make firm predictions about what you think is going to happen in the oil markets. I know what the markets, even looking at the inflation swap data, right? The markets are saying we're going to get a temporary increase in inflation. And then if you go farther out, right, the inflation swaps say, no, inflation will be back down, right? And you don't have to go that far out. So the markets are interpreting this as temporary. I mean, I think there will be, should be, even if the war is over relatively soon, as the president says he expects it to be, it takes some time to ramp up supply again, right? So, even when the war ends, there'll be a couple more months of, high oil prices. But I think even longer lasting, there may be a risk premium in that oil price going forward. Because we've seen a couple of episodes now where oil is taken off, right? We had the Venezuela attacks and oil taken off. We've had this now, oil taking off. So I suspect we'll see um, an oil premium. Will it be hurtful to the U.S. economy? Probably not. But all this depends on really what happens with the conflict and how long the oil is, constrained. And we don't know that yet. So I think when you're sitting around a table thinking about what a monetary policy position you should take, right? Right now, given the labor markets is in relative balance, it's not as healthy as I'd like to see, but relative balance between supply and demand in the labor market, inflation's still elevated. They'd be wise to leave things where they are, their interest rate where it's all until they get more evidence on how things are going to evolve in both employment and inflation.
Well, are you there? There are people out there, including some Fed officials, who do believe there's a real risk of recession and have been arguing that for a while. Where do you see that momentum going? What is the risk of that risk, for
Yeah.
example?
Yeah, I mean, I don't think we're going to get a recession. I mean, before the war, right, things were slower in the fourth quarter. Firms were, reluctant to hire just because of the uncertainty and, and some of the things about going on in technology with AI, but they weren't firing large groups of people. And so, if you look at that, it was sort of people call it low fire, low hire, right? And then there were some positive things in the beginning of the year. People will be getting higher or a lot of people will be getting higher refunds in their taxes. So there is some positive things. And then the investment in AI, data centers, energy that has to support those data centers, that all remains like a positive for the economy. So again, there was positive things in the economy. And I don't have any reason to believe that those, aren't still there. It's just that there's a lot of uncertainty now with the war. There's uncertainty around the terrorists as well. We don't really know where they're going to end up. Although the Trump administration is trying to then change, do the investigations necessary to put the terrorists back on under a different basis than the emergency basis. So again, there's a lot of uncertainty that firms have to deal with, that households have to deal with. I don't think it's at the level of a recessionary problem, but it's something that we certainly have to look forward as we, look for evidence of as we go forward.
Loretta, you said earlier that you don't see a rate hike would be a surprise. You don't see any reason that the inflation will get that bad or whatever, right? That the Fed would even be considering that. It's hold steady or cut. How many cuts do you see this year? When do you see the first one? And again, it's really hard to say, I suppose harder than
Right,
ever because now you've got this big, oil
right,
shock thing hanging over your head, and that could just be
right.
able to sit back and wait.
Right. I mean, let's look, I always think scenarios are better to think about when you have these uncertainties, right? So if you have what I would say was a short-lived, suppose the war ends, in the next 3 weeks, right? The Strait of Hormuz is reopened, traffic gets through there. Then I don't, then I, and coupled with that, we have the labor market remaining in this uneasy balance. Well, I call it an uneasy balance. And we have inflation remaining where it is, but showing that it's sort of on a gradual pace down. I can imagine the Fed would cut in the fall and maybe again in December
Okay,
if that's the narrative. And not necessarily that they should be, but I could imagine them doing that because, there's going to have different views. Some people who really care about the inflation part of the mandate and really want to see more evidence might be reluctant to cut twice and only want to do it once, but or even zero. But if the war lasts longer, that's even more complicated because then you'll see probably more inflationary impulse could end up going into core inflation, but you also may see more demand side effect, right? And it's that kind of balancing that's going to be harder for the committee because then they really have to make a trade-off between the inflation part of the mandate and the growth or employment part of the mandate. And I think that's
yeah,
going to be a much more difficult decision to
but
be
right.
made. And there'll be different people. Certainly other people we know who are on the coming. They will be on different sides of that debate.
Sure. But also, it seems that there is a lot of people think it's very clear that the Fed has gotten more and more towards the labor market side of the mandate. Because if it hadn't, it might have been more aggressive on inflation. Do you see that? And does that kind of then tilt the field in some way towards looking for more reasons to cut rates again?
So I would say it differently. I think there's been learning over time, and you learn from circumstances. Right. So I think, in the economic circumstances we were in after the great, financial crisis, right, we had inflation being low, below target for a long time, right? And we had a weak labor market that took a long time, right, to come back. And I think in that context, right, the committee was really focusing in on the labor market side and also on the inflation side to get it up. But I mean, they were trying to balance those. What we learned since COVID was, right, you can get inflation even if inflation expectations are anchored, right? If you have demand outpacing supply and supply constraints that are lingering and lasting, right? And we're a series of shocks, which we had during COVID, right? Those can make for a more lasting inflation problem. So again, right, then the focus was on inflation. How do we get inflation down? So I think, and they changed the framework, right, to acknowledge that, we have to really be caring about inflation being above goal as well as below goal. After coming out of the great financial crisis, it was okay, we're going to let inflation run a bit hotter, right? So on
Mhm.
average, we get it right because we care about the labor market. So I understand why people said the focus was on the labor market. Then in pandemic, it became on the inflation. Now maybe it's going back to employment. And I think the trend, you could sort of say, okay, that's a trend. But I think it's more, it reflects learning in the circumstances. And my hope is that the committee has learned from the COVID experience. And while they take into account the labor market side, they really need to be focused on the inflation side. I mean, some of the things going on in the labor market now, monetary policy cannot address, right? We have labor participation down. We have or the constrained labor force, right? We have less immigration and we have people who are, retirees. We have a population that's older and leaving the labor force. Monetary policy really can't address those issues. So that's why people say like the break even level of monthly payroll growth is a lot lower. Break even meaning what do you need to see in terms of job growth every month to keep unemployment rate stable, right? That's much lower now than it was pre-pandemic. And so, we're going to get, and the level of that is some say 30,000, some say even less. That's hard for economists who have been in the job for a long time to sort of get their head around just because we're so used to seeing 100, 150, even 200,000 jobs per month. And so the reaction to those low numbers, right, isn't necessarily lower interest rates, right? Because if the labor market is balance in terms of supply being constrained and therefore or lower and demand lower, there's nothing monetary policy can or should do about that.
Well, Loretta Mester, I think next time you're here, let's talk about private credit. Let's talk about that issue and financial stability. Everyone knows you for your monetary policy expertise, your research you've done, your I just always associate you, Cleveland Fed, inflation, right? However, people may not know that you also have a very strong reputation and history of research when it comes to the banking system, this issue of financial stability. And I guess we'll just have to do that next time.
All right. Sounds good, Kathleen. Thank
Okay.
you.
Well, thank you, Retta Mester, President of the Cleveland Fed from June 2014 to June 2024, nearly 30 years prior to that, the Federal Reserve Bank of Philadelphia. So glad you could join us. I'm Kathleen Hayes, and this is Central Bank Central.